In this chapter, you are going to continue your understanding of the law of supply by focusing on the costs of production. Costs of production are things that businesses consider every single day. However, we too should consider costs. If you'll remember the foundational building block of opportunity cost, we all face trade-offs and decisions about our costs. Now, if we think about ourselves, we recall from the previous chapters, our fundamental economic problem is how to maximize our level of satisfaction given the scarce resources that we have available. The businesses have a similar objective. The objective of the firm is to maximize their profit. The objective of the firm is not to make money. It's to maximize the profit that they're going to earn. So if you consider, for example, Microsoft, if at the end of the year, the accountants told Microsoft, good job, you made $1 this year, I guarantee you somebody would be losing their money, losing their job, because $1 really isn't that much profit for Microsoft. But firms want to maximize their profits. And this doesn't necessarily mean that they always want to make as much money as possible. It means that within whatever constraints they may set upon themselves, they try to maximize their profits. So for example, they may try to maximize their profits in an environmentally sustainable manner, or they may try to maximize their profits through a social equity perspective. So sometimes firms do set some limitations on their maximization of profit. So in this chapter, there's an awful lot of terms, different kinds of costs, different kinds of profits. These are all written in the book, but just for definition's sake, a fixed cost is a cost of production that stays the same regardless of the quantity that's produced. So even if you produce nothing, you still have to pay this same cost. If you start to increase your production, this particular cost still stays the same. However, when you start to change the level of your output, then you might experience variable costs. These are costs that vary with different quantities that are produced. We also think in terms of explicit cost versus implicit cost. And explicit costs are costs that really accountants are very good at tracking. These are costs that are paid explicitly. Maybe a check was written or a bank withdrawal was made, or possibly even cash. These are sort of those transactions that are on the books. However, there are sometimes implicit costs. These are costs that are paid indirectly, not necessarily actually written down in any kind of ledger or book, but they are a cost of production. It was a trade-off, this particular cost. We also consider profit. Economists like to consider economic profit. So economists consider both explicit and implicit costs. And if we were to take our total revenue and subtract from it both explicit and implicit, then we would get economic profit. Now, when economic profit is zero, then we say we have normal profit. And this is sort of the minimum profit that's required in order to stay in business. If you realize what this means, it means that you've earned enough revenue to cover just explicit and implicit costs, but nothing extra, nothing beyond explicit and implicit costs. So we have these terms, and it's often recommended that you just make some flashcards or have a listing of the two different kinds of costs, fixed and variable, the different way we consider them, explicit and implicit, and the two different kinds of profit, normal and economic profit. So let's work through this example, and I'd encourage you to just pause the video as you work through this example. So Adam Smith has decided to open a bakery, At the end of the first year of operation, his expenses are $20,000 for supplies, $5,000 to rent the oven, $10,000 to rent the shop. His revenue for the year was $50,000. Before becoming a baker, Adam was an insurance agent earning $30,000 per year. He had $5,000 in the bank, earning 10% interest, but he had to liquidate that in order to start the bakery. So consider, what are Adam's fixed and variable costs? So regardless of how much bread Adam made, he had to pay the rent on the shop and the oven. Even if he never used the equipment or opened the door, he had to pay rent. That's a fixed cost. Now, as Adam starts to bake bread, the fixed cost stays the same. The rent is still the same, but variable costs will change as more bread is produced. So he needed to go purchase $20,000 worth of flour and yeast. So according to Adam's accountant, how's he doing? And according to an economist, how is he doing? So according to the accountant, he says, well, you've earned $50,000 in revenue. You had $35,000 in costs, explicit costs. So the accountant would say you earned $15,000 of profit. Good job. However, consider this. Adam Smith's wife might say, you know, you were earning $30,000 as an insurance agent. Now you're only earning $15,000. Not a good job. Well, really, the economist considers the implicit costs. What are the other things that Adam traded off to open up his shop? He lost that salary, that $30,000 income that he had been earning. He lost that. That's an implicit cost. Now notice in this example, I never told you that he actually paid himself $30,000 in salary. Many small business owners actually do not pay themselves an explicit salary. They simply take what's left over at the end of the day in the cash register, and that's what they live on. But you could turn your implicit cost of a lost salary into an explicit cost, and then that would give you a better understanding of how well you're doing. Let's also consider the money in the bank. He had to trade the $5,000, but he got something in return for the $5,000. He got an oven that he rented. What he really lost was the opportunity to earn interest. So in this case, the interest is an implicit cost of production. So the economist would look at Adam Smith and say, you actually didn't do very well. You actually lost $15,500. Well, if Adam Smith wanted to earn a normal profit, then he would have had to have revenues of how much? He would have had to have had revenues of $65,500. If he earned more revenue than that, then he would have a positive economic profit. And then he could actually say he really was coming out ahead. So another thing that businesses often consider have to do with time perspective. So there's a difference between the short run and the long run. In the short run, there is something that is fixed, a fixed cost. Maybe you're limited in how many pieces of equipment you have on the floor each day. There's something that's fixed in the short run. In the long run, everything becomes variable. So consider a business that maybe they've had a lot of orders coming in. So in the short run, they may just have to work overtime to fill all the orders. But in the long run, they may say, you know, we've been working overtime for 3 years now. It's time to add another conveyor belt. So the short run, you've got something constraining you. In the long run, everything becomes variable. So here's an example of thinking about productivity. You'll see on the left the number of workers and the different amounts of sweaters that they can produce. And in the last column is the marginal product. It's the amount of product that is produced by each additional worker. So you'll notice if we hire 0 workers, we have 0 sweaters produced. When we hire our first worker, they make 4 sweaters. So going from 0 to 1 worker added 4 sweaters to the production. If we hire 2 workers together can make 10 sweaters. Well, the first worker could do 4 all by himself. Adding the second worker, well, maybe that second worker adds another 6 sweaters. There's something that happens. Maybe there's a little bit of synergy that happens between the workers. Maybe one person cuts and the other person sews. But if we hire 3 workers, we get 13 sweaters. So you say, oh, the product is rising. But notice the third worker only added 3 more sweaters. So in looking at marginal product, we'll notice that marginal product of labor, it may go up, but eventually it's going to go down. And the reason has to do with what's written in the first column under number of workers. It says K equals 1. What that means is that shows there's something that's limiting. This is a short run time perspective. So for example, K, economists often refer to as capital. I don't know why it's not C, but it's K equals 1. Maybe this means there's only 1 sewing machine. So 1 worker with 1 sewing machine can make 4 sweaters. 2 workers with 1 sewing machine can make 10 sweaters. So maybe there's that specialization that's happening. But when we add 3 workers, well, there's still only 1 sewing machine. And notice by the time we add the 5th worker, we only gained 1 more sweater. There really wasn't that much more to do because you only have 1 sewing machine. So if you graph this, you'll notice that total product does rise. However, marginal product eventually reaches a peak and then it begins to fall. This is the law of diminishing returns. It simply says that as you continue to hire more and more of this factor of production, then eventually each additional unit gives you less and less. And the reasoning is because there's something that's fixed. So when a business encounters the notion that they're experiencing diminishing returns because something is fixed, they have to ask themselves, is this a temporary thing or is this permanent? If this is a permanent thing, maybe we ought to build another assembly line or get another sewing machine. That's something that would be a long run time perspective. So in this chapter, we also discuss a wide variety of cost curves. We will calculate a variety of average costs and also the notion of marginal cost. So remember your cost of production. So we have this example. If we produce 0 sweaters, the fixed cost is $25 and there are no variable costs because you haven't had to order any supplies. So maybe the $25 is to rent the sewing machine. So in looking at this table, I would encourage you, pause the video and calculate your fixed costs. TC stands for total cost. MC stands for marginal cost. So marginal cost is the difference in cost divided by the difference in quantity. So marginal cost is your change in cost divided by your change in quantity. And then you have average fixed cost, which is fixed cost divided by the quantity, average variable cost, which is variable cost divided by quantity, and average total cost, which is total cost divided by quantity. So the first thing I'd recommend you do is pause the video and at least work through fixed cost, total cost, and marginal cost. So your fixed cost is always going to be $25. No matter what quantity you produce, fixed cost stays the same. Total cost is just the sum of fixed cost plus variable cost. So you'll notice if I produce 4 sweaters, I have $25 of fixed cost and $25 of variable cost. So that's $50 of total cost. The marginal cost, there's the challenge. So marginal cost is the additional cost to produce one more sweater. But you'll notice every time I hire another worker, my outputs don't increase by the same quantity. So marginal cost, you take your change in total cost and divide by the change in quantity. So for example, when I hired my first worker and got 4 sweaters, my cost went from $25 to $50. So the change in cost was 25. My change in quantity, I went from 0 to 4. So that was 4 sweaters. So hiring that first worker means that every additional sweater costs me 25 divided by 4 is 6.25. So every additional sweater costs $6.25. Notice when I hire the second worker, 2 workers gives me 10 sweaters. My change in cost, 50 to 75, is also 25. My change in quantity, 4 to 10, is now 6. So 25 divided by 6 is 4.17. The thing about marginal costs, you'll notice marginal costs go down and then they begin to increase again. And you'll notice that it reaches the minimum at that second worker. When it hires the third worker, marginal costs begin to rise. Now notice with 3 workers, our productivity was beginning to diminish. So that sort of makes sense that marginal product reaches its peak when marginal cost is at its minimum. Now the last columns are your average columns. Average fixed cost is simply your fixed cost divided by the quantity. 25 divided by 4, 25 divided by 10, 25 divided by 13, 25 divided by 15, and 16. You'll notice that average fixed cost goes down. The more we hire, the more we produce, the more we can spread out those costs. Now, a common misconception for small businesses and lots of businesses is the idea that if we could just make more, then it would be cheaper to make each unit. But you have to remember in the short run, something's fixed. So maybe it actually isn't cheaper to make each unit. What really can be reduced as you produce more is your fixed cost. Because remember, that stays the same regardless of the quantity that's produced. The next column is your average variable cost, which is variable cost divided by quantity. So you just simply take the variable cost and divide by the quantities. 25 divided by 4, 50 divided by 10, 75 divided by 13. And then the last column is your average total cost. So technically, it's total cost divided by quantity. You can also mathematically, if you think about this, average total cost also equals the sum of average fixed cost plus average variable cost. That gives you average total cost. So you'll notice while average fixed costs go down, average variable cost and average total cost, they go down and then they go back up again. So if we were to graph these, we would recognize average fixed cost always declines the more product that we produce. Average variable cost goes down and back up again. Average total cost goes down and back up again. Marginal cost goes down and back up again. So in looking at these cost curves, this is just simply graphing that table, the points on that table. This particular pattern is prevalent in all businesses in which they have costs of production in the short run They have something that's fixed, and so they have costs on average, they'll go down. But if you produce too much, those costs begin to rise again, because again, something is fixed. So let's consider an additional question. What happens to those costs if now the government imposes a tax of $1 per sweater? So all of those previous cost curves would just simply shift upwards. Another question, what would happen if the manufacturer acquired some new technology that improved their efficiency, meaning they'd be able to produce more a little bit more efficiently? That means that on average, things would be less to produce. The cost would go down. So technology increases would decrease your costs of production. Yes, you do have to pay for the technology, but theoretically, you acquire the technology because it's allowing you to produce more at a lower cost per unit. Otherwise, you wouldn't acquire the technology. So let's consider the long run. In this graph, I'm illustrating 3 different short-run cost curves, average total cost curves. And you'll notice that average total cost 1, it's very high. Average total cost 3 is very low and at a higher quantity. So maybe this refers to a company that can do things with 1 conveyor belt, 2 conveyor belts, or 3 conveyor belts. So if a firm had to make 60 units, they can do it with 2 conveyor belts. They could also do it with 1 conveyor belt. It would just be really expensive to do. So if they had an order of 60 units all the time, they might choose to actually get the 2nd conveyor belt. Notice if they had orders of 80, they probably would choose to get the 3rd conveyor belt. Now, it is possible that you can get too big. And you'll notice that maybe if you get 4 conveyor belts, you've actually raised your cost of production a little bit. So the long run average cost curve is simply made up of the minimum of all of these short run average cost curves. And your book gives this particular graph that shows that long run average cost curves go down and then possibly back up again. In that area where they are declining, where your long run average costs decline, you have what's called economies of scale. In the area where your long run average costs stay the same, that's where you have constant returns to scale. And in the area where long run average costs begin to rise again, you have diseconomies of scale. The company really would not desire to operate where there are diseconomies of scale. That simply means they've gotten too big. So, for example, let's consider Walmart. Walmart at one time was a small store, a general store. It just sold the basic necessities. And at some point, it expanded. And the original Walmarts across this country really just sold household goods, plates, towels, sheets. They sold some automotive equipment. They sold some gardening supplies, sort of like a very large general store. But eventually Walmart decided to add on groceries. So they made their super Walmarts. So you have the household supply type stuff on one side and the supermarket on another side. So they did that because they figured it would be cheaper per unit to go ahead and add on the grocery store side. It just meant expanding their stores a little bit, filling them up with groceries. Now, at one point in time, Walmart actually toyed with the idea of going ahead and selling cars. So becoming a car sales company. So they have these big, huge parking lots. Why not put some cars in them and sell those cars? But consider what that would do to their cost of production. I mean, how many people go out every day and say, I'm going to get a new car today along with my dozen eggs? Most of the time, they just go every week for the dozen eggs. The cars would be very expensive to maintain on a parking lot, and it really made no sense. So they backed off. And actually, if you've noticed, Walmart now has backed off even further, and they've created neighborhood Walmarts. And really what that's doing is trying to compete with the Dollar Generals. So a firm really doesn't desire to operate in the diseconomies of scale range because it means they've gone too far, and they'll try to back off. So in summary, this chapter introduced you to costs of production, and it's important that you recognize that the goal of the firm is to maximize their profits. And really what they want to consider are both the explicit costs and the implicit costs of production. Not just considering what's on the book, but they look at more than just what's on the book. They look at those implicit costs of production also. We explored the idea that at a certain point, the law of diminishing returns sets in, and each additional unit of labor or each additional unit of capital gives you less and less product because something else is fixed in the short run. And it's important that you understand there is a difference between the short run and the long run. In the long run, everything becomes a variable cost. But most of the time, businesses operate day to day. In the short run, they have something that's fixed. There's some kind of constraint that they're faced with each day. So this chapter just sort of illustrates some of the basic notions of costs of production and help you to better understand the law of supply. In the next chapters, we will begin to explore how firms compete with each other.